Welcome back. You are watching the Skagen New Year's Conference, and we are looking for the best ways to invest in 2024. So, for one thing, do not trust old theories. They may be obsolete. That could be the advice from our next speaker. He is ready to go live from Stockholm, where we have a live audience with us now in Wallenberg Hall. And also in Wallenberg Hall from Skagen is Andreas Buøen. And Andreas, what can you tell us about our next speaker, James Anderson?
Well, Siri, it's not every day we have an investment speaker with us at the New Year's Conference with more than 40 years of experience here in the room. James is perhaps most known for his tenure at Baillie Gifford, where he became partner back already in 1987. While there, he led the European equity team and co-founded the long-term growth strategy and was an early investor in companies such as Amazon, Tesla, and Tencent. He was also the manager of Scottish Mortgage Trust for 22 years. More recently, though, he has joined the investment company Kinnevik, which is a holding of Skagen Vext, as the non-executive chairman, and is today the managing partner and the CIO of innovation investments at the investment firm Lingotto. So, James, we are thrilled to finally have you here in Stockholm. So, please, the floor is yours.
Thanks, Andreas, and thank you all for being here. It's a joy to be able to talk to you, though I must confess, I was quite worried, Andreas, when you had the clock running down there, because one of my totally haunting nightmares, it dates back about 20 years ago when we were doing a presentation for CalPERS, and they just cut you off when the clock goes dead. And my colleague, probably rightly, didn't leave me much time, so I was cut off in mid-sentence. I hope we won't get up to that today, but as I say, it's a pleasure to be here. So, the topic got flawed alpha and what can we do to try and help our clients make money in the years ahead. I feel uncomfortable talking about 1 year independently, but certainly try and talk about the underlying issues. One of the authors, practitioners, not of investment, but of many other fields that I've most admired over the last decades was that great, sadly late Swede, Hans Rosling. One of his many brilliant sayings was that you should always let the data set change your mindset. Or to put it in terms of my native Edinburgh, I was glad to hear Arthur Conan Doyle being quoted earlier today. I'll provide you with another Sherlock Holmesism. It is a capital mistake to theorize without data. So, what is the data? What is the data about what performance looks like, adding value looks like in stock markets? We're told that that can be easily read off some form of standardized, normalized bell curve of a Gaussian nature, which enables people to do all sorts of mathematics surrounding it and to be able to calculate what risk is, somehow defined as volatility, which strikes me as very odd. But the big question is that right? Do such topics as alpha, beta, Sharpe ratios, all this stuff actually exist? And I fear the answer is no, they don't. Now, I hope in a good Conan Doyle sense, because he also said that people's minds are empty cupboards until they start to have experiences. My first feeling of unease around all this was when I found that whether one liked it or not, and many of my colleagues didn't like it, that performance was always generated by 3 to 5 stocks. Nothing else mattered. Even losses don't really matter. It's those small number of hyper winners that matter. So tried to follow up this, and this took me to a gentleman called Henrik Bessenbeiner at Arizona State University, who I used to go and visit in the depths of Scottish winter. And he is now going back to 1926 for the US markets, which if you think about it, it's quite a good date to start at, or 1990 because the data doesn't exist so well internationally. For global markets, simply gone back and, as a matter of fact, providing you with that data that Conan Doyle or Rosling would have admired, said, what has generated returns in markets? Now, this is so extreme and becoming more extreme that any idea that you can think about it as a regular equation is just not true. So I'll give you various forms of this hard fact. Since 1990, just 10 stocks have created a third of the value in the US stock markets over T-bills. Since 1926, when Bessenbeiner first did his research, which was up until 2016, just 90 firms had produced half the value added. That number, astonishingly, is now down to 72 companies. Or if you look at it on a global basis, just 1% of companies have generated all the value added since 1990. You could go on and on. But what we're talking about is a situation with profound power laws rather than regularized returns. Now, how should one think about that? Well, I think the even more disturbing part is that there is no factual evidence that everything that the capital asset pricing model tells you is right at all. Because 57% of companies in America since 1927 have, over their lifetime, underperformed T-bills. There is no systematic return to owning equities. There is thereby very little notion that there is a useful mean in terms of what you're talking about, because the variability is so great. Now, I think this knocks on into incredibly important different issues. It's firstly apparent that you only gather this if you are thinking about the long term. And that's one reason why I think so much of the mistakes has been made. Because if you analyze on a daily basis, monthly basis, even quarterly or annual data, these relationships will not occur in the data. You need to be looking over long periods of time, and at best over the lifetime of companies to talk to this. So I think it is the problem of short-termism really gets everywhere in what we're talking about. And, one needs to thereby, I'm sorry, I don't mean to seem impolite to the organizers at all, to say, I refuse to talk about what's going to happen in 2024. These only become apparent over the course of long periods of time. And as I said, volatility is not a useful measure of risk. In fact, it's probably its polar opposite. Of all those 72 truly great companies in America, they all have drawdowns at least once, and usually much more times than that, of at least 40% in their share price. When you are given opportunities to get away from your mistakes of not owning them in the first place. And I actually think that probably that is the most challenging part of investing. It's enduring those drawdowns rather than actually spotting the companies in the first place, which I'll come back to. So where are we in terms of this? I won't spend much time on the slides, and I hope that's what I've been going through. But where are we now? Will this pattern I'm talking about endure, or will we suddenly have a lovely time when lots of stocks outperform? No, I doubt it. It's partly that intellectual property-based companies are much more naturally exposed to a winner-takes-all environment than much else is out there, and intellectual property companies have plainly become much more important ever since Microsoft went public in 1986. But I think it's also that we have a huge problem in our industry. Markets are becoming more and more inefficient, not efficient, more and more short-termist, and totally, and I think this is perhaps the worst part of it all, lacking in diversity. So, by the way, when it was mentioned that I might not agree with Jonas' speech before, I don't have a problem with that at all. I admire anybody who is prepared to do something differently from the norm. The type of stuff I hate is people trying to pay attention to quarterly earnings and trying to outperform by 1% per annum. I don't think that gets us anywhere at all. But I can admire anybody from Renaissance's extraordinary results trying to think about data to deep value investors. I don't want everybody to think about it in the way I do. I just want them to be different and brave in what they're doing. I would put this in the context of we have to play different games from those that everybody else is trying to do. So I'm, as I said earlier, from Scotland. I know full well that it is completely implausible to believe that the Scottish football team would ever win the World Cup. They may be good enough to beat Norway, but most of us can regard that as something quite easy to do. But what you can do is you can be very good if you're trying to play a different game entirely. Not just do not many people play them, but you can also be extremely unfit if you're to win a darts or a snooker world championship, and these things happen. So I think it's the same in investment. We should always be aiming to play a different game. And the game, as I see it, because of those pieces of data that are so obvious in terms of outcomes, is the task becomes not trying to beat the market, not trying to think about what you're going to do over the next 12 months, but can you identify what characteristics go into making those truly great companies? Because as long as at any point in time I can select one or two of them and believe in them for the next 10 years, you can be pretty bad at the rest of it. To my mind, this is growth at an unreasonable price. Everybody loves the idea of growth at a reasonable price. It makes you feel good. You should never feel good in stock markets. You should always be feeling terribly exposed in what you're doing. Now, unreasonable price is about many of these companies never make the huge, great performance you hope at. And they are unreasonable in the sense of you paid too much. But the outcomes for those that are truly great so dominate that you can get there. And I think one of the experiences that I could most want to try and convey to people is that in almost every truly great company, which I'm fortunate to be an investor, what they've achieved, the upside in earnings, cash flow, sales, share price, but on the fundamentals as well as the share price, have way exceeded even your most fervent hopes at the time you bought them. Now, I think that is something that people feel very, very complex in their attitude towards, because it effectively forces investors to do something which is profoundly different to how they're brought up. you're brought up to be an analyst. But in fact, to do this, you need imagination, and you need to acknowledge that it may well not happen. You've got to cope with uncertainty in it all. Andreas mentioned Tencent in its introduction. I look back with amazement at what we wrote about it 20 years ago, but we didn't get close to what this company became, and I can replicate that for many of the other examples. So you've got to be deeply different, got to be deeply imaginative. Why might that be becoming more difficult? Well, I once, with one of my heroes in investment management, Bill Miller, had a session with a gentleman who many of you may have come across called Charlie Ellis, who used to be one of the great gurus behind the CFA and in writing articles about market efficiency and the like, who believed that it was impossible to outperform because the industry had been professionalized. Now, I absolutely agree with him in the sense that there are many more people doing it. I absolutely agree with him that many of them work extremely hard and many of them are much cleverer than myself, even if not Bill. But the problem is it's been professionalized. Now, I come from a medical family. If most doctors tell you something, it's probably right. If most investors tell you something, it's at best too late. So, I think actually this whole notion that the market has become more efficient is just wrong and directionally wrong in terms of what you're doing. I think another way of putting that would be that I fear that the numbers don't lie. There are something like 220,000 members with a CFA qualification in the world. Now, however much they pretend otherwise, the CFA teaches you that all that Sharpe ratios and Markowitz stuff is the truth about markets. If I compare even the 80,000 people who take the CFA exam every year to awareness of the Best Binder article, which has now been read something like 45,000 times. Now, that's a lot better than it was 2 or 3 years ago, but I think we can see what the problem is. And I think that's reflected in the way people work. And here I become even more troubled because I think it's very dangerous. So I'm a trustee of a couple of university-related investment committees. These people all say at the beginning of every meeting that it's only the long term matters to us. Why would it matter what happens next quarter? But they all become obsessed by just the same issues as everybody else. And I have to say, I am so bored of discussing what the Federal Reserve's policy is going to be. And I just do not see this as a useful ingredient. And I think this takes us into the last point I'll make at this juncture before moving on to some thoughts about what one might do in the future. I think we need to change our whole interpretation of what fund management is. I think most of us were brought up in a notion that stock markets were what they were in the 19th century, that we provided the capital allocation to build canals, railroads, and generally move the world forward. That's not what we are these days. The whole process of financialization has been about making our egos greater. There's a wonderful passage in Tom Wolfe's Bonfire of the Vanities when the failing mock hero has to allow his wife to explain how he makes so much money. And she says it's like baking a cake, except they're not baking the cake, but that each time you pass the cake round, a lot of golden crumbs flow off into your hands. Now, I think that's absolutely right, and I think we need to get back to making cakes, to doing something useful. That doesn't translate into disappointing returns because actually, if you try and make lots of money by the sense of saying, this is going to go up, you won't. You need to employ obliquity. And if you can make yourself think about what creates great companies, then you've got a chance. So to use an example of this, which I think is the most important, where we need to go in the world that we face today, we should be trying to solve problems. Now, I've had plenty of disagreements, and they're not necessarily been comfortable with Mr. Musk, but I really admired what he said to the Sorbonne about why he was trying to make cars. He said, many expletives deleted, and I don't know how they sounded in French, but many expletives deleted, that if anybody thought he was making electric cars to find an easy way to make money, they were being really stupid. This is an intensely hard industry going through a major technological change. But the point is that climate change is the most important problem we're facing, and that is a way of addressing it. I think we should always be concentrating on what we can do to help companies solve those deep underlying problems. Now, I think that requires not just that different time frame I'm talking about, that different imagination, but I think it requires you to have a real understanding of exponential forces. And that is the most important thing that we can do. Chip Miller this morning said that he thought that semiconductors were completely unique in this context. Yeah, I think that's right, because we just don't realize. ASML have tried to work back Moore's law, not just to when Gordon Moore wrote the article in the 60s, but to when they think it first started. They think it first started in 1900. Now, since that period of time, Moore's law has increased the power of semiconductors by 9 million trillion times. I defy anybody not to be able to either make money out of that if they could understand that was going to happen, nor do I believe that any of us in 1900 could really have imagined what was going to happen as a consequence of all this. So I think you need that. And what do you need to get at that sort of information? Well, again, I apologize if I offend anybody in the room, but I have not talked to a stockbroker, apart from to arrange meetings, for several decades. I think inherently they suck you back into this game of guessing and prediction that I really don't believe helps you. I think, on the other hand, you can have enormous joy, enormous advantages by changing your information set. So it's about trying to talk to the greatest intellectuals, the greatest academics in the world, as well as the greatest managers. From the Santa Fe Institute to various individuals that I can name, that really has been where most of our best insights, most of my best insights come about. To go back to the renewable energy and battery technology things. There's a lady called Jessica Tranchik at MIT who 15 years ago was predicting what was going to be able to be done without making any wild leaps. Of course, you don't know precisely when, and she wouldn't claim to know precisely when, but you can have confidence in a way you can't have confidence in market predictions about what that does for you. I'll end, though, on an upmarket thought about this, really genuinely upbeat for all the absolute horrors that happen in our world. And I suppose, in a way, it's come back to Hans Rosling. It's one of his other great phrases about the secret, silent progress of humanity. What's gone on in the semiconductor world is no longer confined to the semiconductor world. That process of deep exponential change is broadening out and is becoming astonishingly important in meeting those problematic areas. Very briefly, I would say that we have close to 100% of the technological means to stop climate change. It's a matter of putting them to place now. Even more excitingly, The healthcare industry has, for a long period of time, been the opposite of Moore's law. Some people say it's Eron's law. But there's real chance that if you combine genomics, big data, with effectively AI enabling us to understand human biology, that the industry may be transformed over the coming years. And many of these companies, completely unlike the Magnificent Seven, have been very, very much out of favor. So I only wish that I was 40 years younger rather than having 40 years experience, because I think the opportunity is, if you think about investing in an independent way for the long term, with these deep, deep forces in your favor, could be enormously exciting. Do I promise that will translate into returns in 2024? No, I don't. But I don't really see why that ultimately matters. What we should be trying to do is build great companies that advance the world and, in the long run, provide magnificent, well beyond market expectation types levels of performance, but you can't guarantee it every year. So hope, but long-termism is where I'd like to leave it. Thank you.
Thank you, James. Don't want to sound like your teacher here, but thank you for a very solid presentation. So we are now starting the Q&A session. And like I said earlier today, for all of you here in the Wallenberg Hall, you just raise your hand and you can then pick up your microphone that's next to your seat, press the button. When it turns red, you may speak. But I'll just start with one question, James. Building on the contention that markets are becoming more inefficient and short-termist, it should actually suggest that it could be getting easier then to generate alpha and excess returns. So why do you think that so few stock pickers actually do outperform consistently? And what should you, as an asset owner, look for when choosing an active manager?
So, firstly, if you'll allow me, I will take out the word consistent, because I think that's dangerous, because, I do not believe that you can add real value if you are preoccupied with trying to beat the index on a quarterly basis or whatever. But I'm really not meaning to get away from the big part of the question. And just, I don't think it is surprising that most people don't, because I think most people are following, as I was trying to indicate, those professional instructions that you get. And that, more and more academic research would tell you that people are so intensely sociable that they do not want to go out of the norm. And once there is an accepted way of thinking about anything, then I think that you get that danger that people will be playing the same games and playing them badly. I would say this feeds through in company terms as well. Just about all those 72 companies that I was talking about earlier, in fact 71 of them, the sole exception being IBM, was doing something at the start that was deeply controversial. You remember with Amazon what it was thought it would be doing. And I think you therefore should, as asset allocators, employers of managers, be trying to find people who show the ability to think completely for themselves. And that, you can tell whether it actually makes sense or not. And they need to go about doing that in practice as well as in their words.
Thank you. Very interesting. Do you have any questions from the room? If you just raise your hand and ask your question. Typically Sweden, huh? So over then to another question. As a very long-term investor, what actually tests your patience? And are there any triggers or behaviors in companies that are, for you, an automatic sell signal?
So I think ultimately, and I think this is really important, that the whole notion of what companies need to be aspiring to, if this data is correct, as I see no reason not to think about it, needs to become much more demanding, much more radical in terms of what's doing. So what I've always tried to do on that score, and we can talk about millions of other different examples, but that companies have to keep wanting to be ambitious in what they're doing and to try and be ambitious to grow. All the data tells you that these companies need to be growing at somewhere bottom 20%, more often 30% plus per annum for the next 10 years to be in the top cohorts of outcomes. So I shall now give an example of my sheer stupidity in putting this into practice. I sold Apple 6 or 7 years ago because I thought they had become deeply conservative. Now, that analysis was totally correct. Tim Cook actually hates innovation. It's not, the notion that it's anything like Steve's company is a very strange one. But what they'd built was just so huge that they didn't actually need to do anything other than milk it. So, I would absolutely keep to that view that you need to keep having companies that carry on being outrageous. But it hasn't always worked.
So how much of a role do you think then valuation actually plays? You mentioned Apple and that you sold the stock 6-7 years ago. And can any multiple be justified if you think that you've actually found an outlier?
I think that's absolutely right. But I used to get quite annoyed. I think I've got over it now when people said you don't care about valuation, because I think I absolutely do care about valuation. But there are two parts of that you need to factor in. Valuation, as we all ultimately know, is the long-term free cash flows of a company. It is not the PE next year. That tells you nothing about the value of a company. And equally, in thinking about those long-term free cash flows, you need to acknowledge profound doubt. I used to get, and my colleague Tom Slater used to get, about 10 documents from hedge funds every month saying, this is what our value of Tesla is, and this is why you're stupid to own it. And they all provided you with a set figure at the end of it. Now, we don't know. So, I always thought in value, you were trying to get those long-term free cash flows, but I always have, and still do this, usually about 5 different scenarios and assigning some sort of loose probability around those to what matters. Because I don't think I know that much about what's going on. So I think we need to have humility about this. But valuation absolutely matters, but it's about those long-term free cash flows.
Did I see someone here in the room? Yeah, please just use the mic. Thank you.
Index investing have been very popular over the last decade. That has obviously created good returns because you get inherent alpha through the Magnificent Seven.
Yeah.
Do you think that this trend will change, going back to more actively managed portfolio strategies?
So it might be worth saying in context of this, my largest client at Baillie Gifford and people who I was deeply fond of were Vanguard. And we had this conversation often with them and going through the best and binder data, and we got him to go and talk to them, etc. There are 2 possible ways to go. One is to try and be very explicit in saying you can have an edge in selecting these companies because other people aren't trying to play that game. The other, and Vanguard were very comforted by this, was to go down the route you're suggesting, that you will get exposure to it. Now, I don't think they would be offended if I said that there is one complication in this, and a complication that until the last couple of years was a very serious problem for index providers, which is companies were going public much, much later on. And what do you do when a Facebook, a ByteDance, or a SpaceX isn't going public until they're worth more than 100 billion, because you can't necessarily within those structures get exposure to it. It's very difficult from a cost point of view, quite apart from anything else. So I absolutely think that philosophically that is one answer, one of the two potential answers, but it has its complications.
We had an interesting talk during lunch here regarding countries and their ability to innovate.
Yeah.
We compared Norway and Sweden and the UK. What conditions and structures do you think need to be in place to help support innovators, and what are the barriers that you see?
Yeah, I think I'm glad you asked, just because I think this is one of the serious problems that we face, and I would argue that actually the more prominent financial markets are in any city, the more difficult it is to do this. I think the most of it, though, is about regions rather than countries. People used to say, I had lots of money invested in America. Well, no, not really. He used to have lots of money invested in a 100-mile stretch of the western states of America, which was profoundly different in its notion of capitalism. But I think there is something here. I mean, if people talk, you read Taleb and people like this about power law type returns and non-Gaussian returns, they will say that one of the prime characteristics is interdependence. And I think that's true of businesses too. I think you need this whole ecosystem and this sense of tradition and following up something that you do there to be very strong. And I often think that Silicon Valley, there's so many stories about individuals and the like, but I actually think it's much more like one giant Japanese Kairetsu or South Korean chaebol, in that really these people all cooperate with each other at most levels, and the skill sets are all there, and I think you need to do that. And I think, by the way, there is something to me intensely admirable about Sweden from that point of view. And as you probably guessed, I don't normally say things that are tactful, but I really, really mean this. How, despite all the pressures, the entrepreneurial tradition in this country survives and flourishes still strikes me as truly remarkable and deeply unusual in a European context.
Siri, are you with us from Oslo with a couple of questions, perhaps from the audience on the platform?
Absolutely, and questions are coming in, and I'd like to bring in one here about playing a different game. Is Kinnevik playing a different game when it comes to investment? And if Kinnevik is doing that, what is the goal?
Oh, I think firstly it plainly is, because the results over various different time periods, but certainly including last year, would not be so different from the market if you were playing the same game. No, I think the type of philosophy that I'm talking about here is not because of me, but it is absolutely right. It is saying that if you can back truly great entrepreneurs trying to address serious problems, then you will, over the course of time, have a real chance of making great returns. I fear the word goal is, in a sense, one of the unusual phrases that throws up, that throws up that we can't get out of our mind football when we're talking about this. I used to have lots of talks in America about the difference between cricket and baseball. The main one being that in cricket you don't have to run when you hit the ball. And I think, to a certain extent, that is true of Kinnevik, though I never tried this comparison on the management, who I suspect might not know that much about cricket. I think what you're trying to do is say you can, over the course of time, have a dedication to a small number of companies that have the opportunity to enable you not just to want to run, in cricket terms, but also to take up Jeff Bezos' analogy, that in baseball, he always used to complain when people talked in baseball terms, as they do so often in America. If you succeeded, you hit a grand slam, that was only 4 runs. In baseball, that's a constraint. In business, it's not. In business, you can make hundreds, 1,000 times your money. And I think that that is what we are aiming to do over the course of time with Kinnevik. Of course, I'm deeply aware of the complications of the time and, acknowledgement of mistakes that have been made. But that is the objective.
Thank you.
Let's have a second
Typical,
question from the audience. We have a vast digital audience today, and we're getting questions from them as well. And one says, you said you have not talked to a broker in many years. How would you apply that approach for private investors without a huge network and access to the industry experts?
Well, I think it may go back to the prior question about what, for whom is it right to be trying to hit these home runs or exaggerating? Who is it better to be cheap, cheaply fed, an index-type product? And I think in many cases it is better for people to do that. I don't expect private investors to have the same obsessions that I or other investors I admire as. They've got better jobs, more important jobs to be doing. And hence I actually think it is very hard. But as a retail investor, you do have one advantage in that you can set your own timeframes and you can set your own targets. You don't need to face the pressures that I'm sure you and your colleagues feel of justifying how performance has been over 3 or 12 months. And I think that, the best way to think about what you can do well as a private investor is to think about, what's important to you and over what period of time are you looking to attain it.
And we can have one last question, Andreas, there from our digital audience. It's about timing, and how do you know when it is right to actually engage and invest?
I think that is incredibly hard to do as a market timing issue, but I think the other timing angle is important. I've increasingly noticed that you should not invest before any broadly defined area, say synthetic biology, gets to 1% of its potential. And you shouldn't invest in individual companies exclusively until you get to 5% market shares. I think you learn more at those moments. So those are driven not by the market's mood, the market's pricing of it, but how they are in genuine business terms. Again, to go back to the Amazon example, when internet retailing in America first became a big issue, I owned both eBay and Amazon because I didn't think at that time we got to the 1%, but we hadn't got to the 5%. I didn't think you could tell who was going to be the winner. Now, in retrospect, that seems really stupid because there was no comparison between them. And I was only finally confirmed in this view when talking to the then boss of eBay who got up and said, "I'm no Jeff Bezos." And I thought, yeah, you are no Jeff Bezos, and that matters a lot within this. So I think it has to be about your own disciplines as an investor rather than what the market's imposing on you.
Thank you so much, James, for being with us and giving us your experience here. Many thanks on behalf of the viewers that have put the questions up for you. And many thanks also to Andreas from Stockholm.
Thank you.
Thank you.